Now I'd like to introduce C.Beyerhelm. He's the Assistant Deputy Administrator for Farm Loan Programs with the Farm Service Agency, and he's located in Washington, D.C. Chris grew up in rural Iowa, and if you want to learn more about Chris, I advise you to go to our webpage. And Chris's voice will be sound a little different. We had to solve some technology issues to broadcast from within the federal government. So, Chris, the program is yours now.
Thank you, John. Appreciate the opportunity to be here today. I want to tell you a little bit about Farm Service Agency before I get started here, just so you have some perspective of my comments. Those of you that aren't familiar with us, we are a government agency, part of USDA. We make agricultural loans to beginning farmers and financially distressed farmers. So really what that means is that at the entry point, we become a player. We try to stop the exit financially stressed farmers. And why that's important, I think, for today's discussion is that the size of our portfolio is a good barometer on what's happening with the strength of the credit exit. So I want to just, my first slide here is to see a little bit about our portfolio currently looks like. 68,000 borrowers, 25 billion direct side, 33,000 guaranteed borrowers, 2 billion. 2008 activity is about 3.2 billion, 7,000 customers. And the 6-month mark for 2009, we're at 20,000. So I hope you can see the significance of that mark. If you double that, I think it's reasonable assumption. You can see that the activity in our portfolio was picked up dramatically, which I think is an indication of some stress. Part of my job today was to talk about agriculture in uncertain times and what are the likely impacts of the non-ag credit market meltdown to agriculture. And there's a number of them in my mind, but I want to talk about these 5 specifically today. Farm land values, we've already heard quite a bit of conversation about that. I won't dwell on that too much, maybe just a little different perspective. Farm lenders, the most important to me and why I've got it in red is the demand for commodities, and by that I mostly mean globally, and how that's going to impact on the bottom line of our customers. The next one is more specific to Farm Service Agency and our clientele, non-farm income. Most of the small and medium-sized farmers we deal with rely heavily on non-farm income, and as a result of increased unemployment rates and other things going on in rural communities will have an impact on us. And then finally, tighter credit standards, and that's already been discussed to some extent today. So farm land values, you've seen variations of this chart already today. Basically, you can see that there's been a fairly steady increase except for the farm crisis times during the 80s, where we've seen an increase in land values. I just want to call your attention to the far right side of the chart. In the last 3 years, there's been a 42% increase in land values. And that increase has been primarily driven by 4 factors, and you can see those on the right side of your screen. The housing market, the ethanol, world demand, and low interest rates. So for those of you that want to take a flyer on what's going to happen to land values, you can just answer those 4 questions. What's going to happen to the housing market? What's going to happen with ethanol development? What's going to happen to world demand? And then lastly, what's going to happen with interest rates? And we might answer a few of those questions as we proceed here. This next chart, I'm sure you can't make it out very well, but I'll explain it to you quickly. These are annual change in average land values from January 2007 to 2008. The yellow portions are where there was a reduction in land values. The green portions are 0 to 15% increase. The blue, 15 to 20, and the darker blue are 20 to 25%. Now, so you compare that with, and I apologize, the FEE survey should be the Federal Reserve survey. Compare that with their indicators in the 4th quarter of 2008, and you can see that in Chicago, down 4%, 6% in Iowa, and that's only the 2nd quarterly decline since the 1980s. And then you can see the rest, Kansas City down 1%, Minneapolis down 4%, dry crop land 5% on ranch land. Dallas area down 2% on cropland or rangeland and cropland flat, and Richmond down 1% and down 8% for the year. So you can see that there's some indications that there might be, if not a reduction, certainly a slowing in agricultural values. Next, I want to take a look at lenders, and some of this has already been said by the two previous speakers. Delinquency performance has been strong. Delinquency loss rates, the Farm Credit System, commercial banks, life insurance companies has been historically low, but has been trending upwards in 2008 and certainly in 2009. Just from the FSA portfolio, we're at 25-year lows in delinquency rates and default rates. And ag banks and farm credit system associations were strongly capitalized going into the current financial downturn. So just who are the suppliers of farm credit? You've heard some of them today. You can see commercial banks hold about 39% of the ag credit outstanding in the right-hand side there. Farm credit's about 31%. If you look down at the left-hand quadrant, the bottom left-hand quadrant, you can see that the FSA portfolio is about 3% on the direct side and 3% on the guaranteed side. And again, I hope you can see the significance of that as we go through some additional slides here and what we might see as we continue. Just some more information about the current status. Farm economy is coming off two strong years. 2007, 2008 were fairly strong. You can see 2009 forecast, not as strong, but certainly reasonable to continue to expect profits. If we take a look at input costs are declining in all of the major areas. The red line there is feed, the blue is fertilizer, and the green is fuel. So all three, what I would call certainly three of the major inputs into agricultural production are on the downside. I think the counter to that is that there are certain commodity sectors experiencing great difficulty, and those have been mentioned already today. Dairy, poultry, greenhouse, nursery, and I think you can certainly add the hog industry to those areas. Any lender that is heavily involved in either one or multiple numbers of those different commodities is certainly going to see some stress regardless of what happens with the economy, just because those particular industries are in stress. I think another indicator, if we look at the next slide, so even though there's some positive things on the horizon, I think that we still see that the pace of debt accumulation relative to farm incomes indicates relative cash values are weakening. And if we look at this chart, basically it covers 48 years, close to 50 years. You can see the green line down the middle is basically an average, about 3.5% net cash farm income to farm debt ratio. And you can see that other than the farm crisis years during the 80s, where we dipped far below that line, since that time we've been pretty much above that line. But there is a difference at the end of it. Again, if you look to the right side of your chart, the estimations, which is the red line of the Economic Research Service, pretty much shows that we stay above that line. We get close to it, but we pretty much stay above it. But if they take a look at the blue line, which is information based on lender-reported farm debt, you can see that there's a little more pessimism in those numbers. So, again, we're, I think, at a crossroads here to see what's going to happen next. Just some other information. Debt has been rising at a rapid clip. The green part of the bar is bank totals. The red part is farm credit systems. I do want to say that even though debt is rising, certainly the balance sheet of agriculture as a whole is very good. It is not very highly leveraged, and certainly not in any kind of a situation that I think needs to cause us concern. What causes me concern is that the debt is rising. I think the asset values have risen at a faster, or at least equal rate, but depending on what happens to land values, even if we take the fourth quarter numbers we talked about, like in Iowa, down 6%, unless I reduce my debt by 6%, I have lost net worth. So what I always say is you can lose asset value without, on paper, so to speak, but you actually have to pay down debt. So I think there's some situations here that we need to watch closely. Along with that, I think the other speaker mentioned we're starting to see a deterioration of non-performance in loans. Nothing really serious, but certainly you can see in 2008 on the far right hand of your chart again that default rates in all categories are up. Over the last 3 years have been fairly good. So these are the highest they've been in the last 5 years. So again, just some indicators that perhaps we need to be more conservative and we'll watch what we're doing. So if these trends continue, what happens? Well, this is where, when I talked about earlier, watching the portfolio of the Farm Service Agency as a good barometer comes into play. If you look at this chart in front of you, which is basically a 38-year chart on the percent of ag credit that the Farm Service Agency holds, you can see during the 80s, the red line in the larger circle there, during the farm debt crisis, the Farm Service Agency actually held close to 20% of the total ag credit outstanding, compared to the 3% we hold today. So a real big question is that if you see that red line start inching upwards, that is going to depend on Congress supplying more loan funds in order for us to provide additional credits. So again, one of the speakers I think talked about government intervention. I think this is one of those places where, if it's needed, certainly government intervention would most likely be a good thing, because the Farm Service Agency does provide a safety net for times like this when we see stress in the agricultural markets. Just some other additional information I'll go through fairly quickly. Net returns per acre are expected to fall. You can see a fairly significant decline from 2008 through 2010. And then for almost all of the commodities, they taper off and still remain at reasonable levels. I think what's important here is that what I call the price expense squeeze is that sometimes decisions get made based on a higher price when expenses are within line with that higher price, but then after the decision has been made and the inputs purchased is when you'll see the decline in the price, and then you're caught in that squeeze. So I think in summary, I think lenders are okay. They're fairly well collateralized, but there are indications that portfolios are starting to sense some stress. And again, like I said, I think we're at a crossroads depending on how long this situation lasts. The next thing I want to talk about are the impact on commodities. We've seen reduced demand for red meats and poultry, less eating out, dairy domestic demand weakening, restaurant sales are down, sales of value-added products have also fallen, exports are declining, worldwide production's increasing, and we're coming off a period of higher demand, which has resulted in increased herd liquidations, and certainly in the poultry industry, we've seen reductions in poultry contracts and production in that arena. In the crop area, near-term weakness in the global economy, diminishing demand growth for crops. We think it's over a short period of time, but again, who knows? Corn-based ethanol production in the United States is projected to slow, remain at a relatively historically high level, comparative. Reduced demand for soy products, reduced domestic demand and prices, an increase in global consumption and trade, although lower, are expected to return to high levels, resulting in higher commodity prices over a longer term. So again, the jury's out just a little bit on this particular issue. Importance of farm income, I think I've already pretty well covered that. Again, this is somewhat unique to our agency. I know other lenders have customers who depend on non-farm income, but it seems like the bulk of our portfolio, because they're small and medium-sized farmers, because they're more susceptible to layoffs in the rural communities, are going to impact positive debt service capacity in our particular portfolio. Tightening credit standards, again, sound like a broken record here, but it does depend on the length of the economic crisis. Strong balance sheets and past profits carry most farms through 2009. Farm lender stress will continue to rise. Ag loans will not be the primary driver, however. I think that's already been mentioned. Stress is going to be driven by the Main Street consumer and commercial loans. And I think we've seen that so far in fiscal year 2009. We've had 48 bank failures compared to 4 in the same period of time in 2008. And it is important to note that the majority of those are not ag banks. 3 to 4 of those are ag banks. And it's my understanding that maybe one of those was because of agricultural loans. And the other 2 or 3 had to do with their investments in toxic assets or derivatives. But a bank failure is a bank failure, and I think it still impacts our local communities and has potential to impact our agricultural communities also. Number of banks and farm credits with reduced capital has risen. We've seen more banks go on the watch list than have been recently. And the timing of the price-expense spread, which I talked about earlier, I think particularly in 2008 is a great example of that. When corn was $4 a bushel or more, expenses increased accordingly. Decisions were made. Crop inputs were purchased, loans were made, and then the price of corn went down. So there's always that risk. And I think another thing are variable interest rates. Much of the debt that's outstanding right now is on variable interest rates. And I think most projections, if not all, are projecting that interest rates are going to go up at some point. So for those customers that have variable interest rates, obviously that's going to be something they're going to have to manage as they go through. One of the things I was asked to address is the biggest disconnect between lenders and producers, and the first one's already been talked about in great detail, so I won't spend a lot more time on it. And it is cash flow lending versus asset or equity lending, or whatever you want to call it. I even look at this even a more simplistic view, and the question is not can I afford it, but can it afford itself? So if I'm going to buy a tractor, I better be able to show that in a combination of more fuel efficiency, less passes across the field, or lower equipment repair expense, that I'm going to be able to that tractor is going to actually pay for itself and be able to make the payments on it before I buy it. And I think the earlier speaker was right. We learned that lesson in the 80s, and it never pays to be cash flow or to be equity lenders. I think the other one is the biggest connect we see is that I think both lenders and our customers come into the business with the business decisions being made with their head. They're going to buy a piece of property. What's the best value for it? What's it going to produce? How's it going to fit into my operation? But once purchased, it all of a sudden takes on a different kind of a personality, I think, with our customers, and it becomes part of the family, if you will. And even though there are opportunities to sell, or if you're in the dairy or the hog industry and maybe it's time to get out, you just can't do it because of your emotions that are involved. And I think the best example I can think of this is some of these land values that have gone sky high, when we've literally had some farmers that could have made themselves multi-millionaires overnight just by selling their property, but they just could not bring themselves to do it. Not suggesting they should have done it. I'm just simply saying that the decision-making changes from one that's made with the head to one that's made with the heart. It's educational needs for producers. Just to kind of wrap up the last of my presentation, is I believe educational needs are management of input and output needs, especially important in times like this. When the margins get thinner, we just have to have a good ability to manage those things. The capital cost management, which is basically the equity lending versus cash flow lending. How are we going to position our capital to best give us a return for our operations? And then I think lastly, when are two birds in the bush better than one in the hand? And I'll say not very often, but there are some times where it does pay to leverage yourself and to gamble. I certainly don't think this is one of them. But as we come out of this, there may be some opportunities for that. So I think producers need to make sure they educate themselves on when it's appropriate to take on more risk. So in conclusion, basically summary is farm land values are beginning to decline. Whether that continues, I think, has a lot to do with those four factors we talked about: the housing market, the interest rates, the global demand for our commodities. Farm lender stress is rising. Ag loans are not the primary driver, driven by Main Street consumer and commercial loans. Worldwide economy will dictate the future of demand for commodities and therefore begin to impact agriculture if not corrected. And the credit availability, instead of saying will tighten, it already has tightened. And I think that we're at the increase in the Farm Service Agency portfolio is evidence of that. And marginally capitalized banks and producers will become more vulnerable and have to, particularly the producers, have to start becoming better managers to mitigate some of that risk. And finally, the million or billion or trillion dollar question is, how long will it last? Thank you, and I'll take any questions.
Chris, thank you very much. Maybe while I give Chris a couple questions here, Kurt and Jay, you can turn your audio on or be prepared to turn it on if you have questions. I'm getting a little feedback from someplace. For the audience, we're going to go with about 10 minutes here for Q&A. And just quickly remind you that a week from today, on June the 17th, again starting at the same time, we will have three individuals who work very closely at the producer level. One out of the input supply business, the other two have had significant experience at the loan officer level, and it should be a very educational program again a week from today. I'll just put that plug in. But Chris, I'm going to ask you one of the questions that we asked Kurt, and it's from your perspective in terms of the loan applications that come to the Farm Service Agency. What are the main qualities that you look for in evaluating current or prospective customers?
Well, the main quality we look for is that when they come into the office, they have a very detailed plan in a clear direction and a view of where they want to go and how they want to get there. So if you want to call it a business plan, that they have thought through all of the options, they've thought through the pros and the cons, they've thought through what's worst case scenario, how much risk am I willing to take. And I think the other part about it is what we're looking for is if there is more than one person in the operation, whether it be husband and wife or corporation partnership, that all of the principal parties are there and that they are all on the same page, so that there's no dissension among the ranks as they move forward with their operating plan.
And you closed your presentation talking about the million-dollar question. What do you think some of the indicators that are going to help us answer that million-dollar question?
Well, as I said, I think that one of the things we want to look for is global demand to see whether or not or how much the global demand is going to be impacted. So I think that's one thing to take a look at. How quickly we come out of this housing market, I think, will be an important indicator of what we want to look at. And I think what happens with interest rates to a lot of respects, not so much that's an actual indicator, not an indicator, but an actual impact. But I think perception-wise with a lot of people, as interest rates go up, they equate that with I really need to hunker down here. I need to get more conservative. Don't want to pay more interest. So I think if we look at those areas, look for land values. If land values continue to decline, I think lenders are going to get more nervous. Even though a lot of them are doing cash flow lending, still like to see those balance sheets stay healthy. And as I said, those land values can decline through no fault of the customer, but the debt has to be paid down.